Imagine dropping $2 billion into Bitcoin in a single day.
Right, just a massive wall of money.
Exactly. You'd expect to send the entire market straight to the moon, but instead you just watch the price hit a brick wall and, actually slide backward.
It's pretty wild.
It is. And that is exactly what mega bull Michael Saylor just did. So, welcome to the deep dive. Today's Monday, May 18th, 2026.
And we've got an absolute mystery for you today.
We really do. We're looking at a massive stack of sources for you. We've got a major crypto market newsletter, a fresh news digest, and some incredibly detailed summaries from top YouTube analysts, Benjamin Cowan and Coin Bureau.
Yeah, those are some really dense reports.
They are. And our mission today is simple but urgent. We need to figure out why the momentum in the crypto market has just, suddenly vanished.
Right. What are the hidden forces actually driving the markets under the surface right now?
Exactly. Because it's a truly bizarre moment to be watching the charts. I mean, the surface level headlines, like a $2 billion buy wall, are completely contradicting the underlying market data.
They really are.
So, okay, let's unpack this. Because if a $2 billion buy from one of the biggest, loudest players in the space can't prop up the price.
Yeah.
And we are sitting here watching Bitcoin literally slip below the $80,000 mark. What on earth is dragging the market down?
It's the big question.
I mean, a buy that big should have triggered a massive rally, right?
Well, you would think so. But to really understand this crypto dip, we actually have to, zoom way out.
Okay.
We can't just look at the order books on a single exchange anymore. We have to look at global geopolitics, institutional capital flight, and historical market psychology.
So it's much bigger than just one guy buying a lot of Bitcoin.
Exactly. The forces dragging the market down right now are much larger than any single purchase, even one as massive as $2 billion.
Wow. All right, let's start with the big picture then. Because according to our market newsletter source, the crypto market is currently being suffocated by a broader macroeconomic storm.
A very heavy storm, yeah.
Right. Now, we need to talk about the geopolitical trigger that set this latest sell-off in motion.
Uh-huh.
Now, it's really important to note for you listening that the market, it doesn't care about politics.
Not at all.
It only cares about risk. So regardless of where anyone stands on the newsletter's report about President Donald Trump's recent warning regarding possible military action against Iran if peace negotiations fail.
Right. The market doesn't take sides on that.
Exactly. The immediate market reaction to that news was simply a severe spike in oil prices.
And that oil spike is the domino that knocks over everything else.
How so?
Well, when oil prices shoot up, the cost of manufacturing and shipping goes up across the board. And that reignites inflation fears.
Oh, right. Because everything suddenly costs more to make a move.
Exactly. And when inflation fears rise, the market suddenly expects the Federal Reserve to keep interest rates higher for longer to cool things down.
Okay, but I want to push back on that for a second.
Sure.
Why does the expectation of higher interest rates instantly crush a decentralized asset like Bitcoin? I mean, Bitcoin isn't tied to the Fed.
It's not directly tied, no. But it's because of the ripple effect higher rates have on the U.S. dollar.
Oh, what?
High interest rates make holding U.S. dollars much more attractive. You can get a guaranteed, basically risk-free return just by sitting in cash or government bonds.
So people just park their money there instead.
Right. We are seeing the U.S. dollar breaking out higher right now because of this exact dynamic. And historically, a strong rising dollar acts as a crushing weight on risk assets.
Because Bitcoin is priced in dollars.
Exactly. If the denominator of the dollar gets stronger, the asset's price naturally goes down.
Wow. So the macro environment gets scary, the dollar gets strong, and the big money just runs for the exits.
That's in the playbook.
I mean, I was looking at the institutional data in the newsletter, and it genuinely shocked me. It's not just, retail traders getting spooked on Twitter. The actual smart money is fleeing.
They absolutely are. The newsletter notes that Bitcoin ETFs saw nearly $1 billion in net outflows just last week.
$1 billion. Just gone.
Yeah. And if you look at the Coinbase Premium Index, it is deeply in the red again.
Okay, for those of you who might not track that specific index every day, why does that metric matter so much?
It's a crucial behavioral metric. The Coinbase Premium Index measures the price difference between Bitcoin on Coinbase.
Which is the platform the big U.S. institutions use, right?
Yes, primarily. It compares that price to offshore exchanges that are heavily used by global retail traders. So when that index is deep red, it means Bitcoin is trading cheaper on Coinbase,
Got it.
which confirms a significant measurable drop in buying interest specifically from U.S. institutions.
And when we talk about institutions, we aren't just talking about like high-risk hedge funds. Harvard University, which sits on one of the largest endowments in the world, is actively slashing its crypto exposure.
Yes, the data is pretty stark. They just cut their holdings in the IBIT Bitcoin ETF by 43%.
That's huge.
And even more aggressively, they completely dumped their Ethereum ETF position.
Wait, really? All of it?
All of it. They
Yeah.
sold off their entire $87 million stake.
But wait, endowment funds like Harvard's are designed to think in decades, not days? They're supposed to be, the ultimate diamond hand investors.
They are.
So if they're dumping $87 million of Ethereum right now, they must see a serious storm coming.
Well, if we connect this to the bigger picture, it tells us that they see a severe liquidity drought on the horizon.
Okay.
Because the macro storm isn't the only thing sucking money out of the room right now. The newsletter points out a looming event that could drain even more speculative capital from the crypto markets.
Which is?
The upcoming SpaceX IPO in June.
Oh, that makes total sense.
Right.
Because institutional capital isn't infinite. If you have a bucket of risk-on speculative capital, an IPO like SpaceX, a highly anticipated tech and aerospace giant, that is exactly where you want to park it.
Precisely. The market only has so much liquidity to go around. SpaceX going public threatens to siphon off the very dollars that would otherwise be flowing into Bitcoin or Ethereum.
Wow.
And this is all happening right as we head into the summer season, which is historically a period of very low liquidity and weaker trading activity anyway.
Right. So the water is just draining from the pool.
Exactly.
So that makes the whole Michael Saylor's situation make so much more sense.
Yeah, it does.
It's like two whales swimming in opposite directions during a hurricane. It isn't that his $2 billion buy didn't matter. It's just that the broader market is pulling capital out faster than he can push it in.
That's a great analogy. The risk of a broader bear market is rising not because the crypto asset itself is fundamentally broken, but because the macroeconomic environment is forcing this massive capital reallocation.
But hold on. Let me play devil's advocate here.
Go for it.
If the macro environment is this bad and money is fleeing, how do we explain the massive rally we saw just a few weeks ago? April and early May looked incredible.
It really did.
People were celebrating, which actually brings us to the summary we have from YouTube analyst Benjamin Cowan.
Right. And this is where we transition from the why to the how.
Okay.
The macro environment explains why money is leaving, but the historical technical data shows us how this cycle is actively playing tricks on investors.
Playing tricks.
Yeah. Cowan argues that the very strong rally we just saw wasn't a new bull run at all. It was a classic bear market bounce.
Okay, wait. A bear market bounce. If prices are going up consistently for months and billions of dollars are flowing in, how is that just a bounce?
It sounds counterintuitive, I know.
Right. Like, at what point does a bounce just become a legitimate bull market? It sounds like a trap.
It is absolutely a trap, and that is Cowan's main point. Bear markets are incredibly devious. They don't just go straight down in a straight line.
No, of course not.
A bear market bounce traps both the overly eager bulls and the late-to-the-party bears by rising for months. It looks totally convincing.
So it's not like a false summit in hiking. I know people use that analogy where you think you've reached the top of the mountain, but you've just hit a ridge and the real peak is miles away.
Right.
It actually sounds more like the receding tide right before a tsunami hits.
Oh, that is a much better way to visualize it.
Yeah, like the ocean pulls way back and the beach is suddenly completely exposed. All the retail investors run out onto the sand to pick up seashells.
Buying the dip, riding the bounce.
Exactly. They're completely ignoring the massive macroeconomic wave that is building on the horizon. And then, it just crashes down on them.
That perfectly captures the psychology. And Cowan points out that we have seen this exact tsunami trap before.
Really? When?
He draws historical parallels to the markets in 2014, 2018, 2019, and 2022.
Wow, so the pattern.
A very clear one.
Yeah.
In every single one of those years, Bitcoin had strong multi-month relief rallies. Everyone got convinced the bull market was back. They ran out onto the sand, and then the market rolled over and plunged to brutal new lows.
Ouch. And he backs this up with some pretty dense technical analysis in the summary, right?
He does. He notes that Bitcoin is currently struggling right at the 200-day moving average,
Okay.
and it reversed exactly at the 0.382 Fibonacci retracement level.
Okay, but for anyone listening who doesn't, stare at charts all day,
Yeah.
why do these arbitrary lines on a graph actually matter? Why do they have the power to stop rallies?
Well, they aren't magic. They are reflections of human psychology and market memory.
How so?
Take the 200-day moving average. It represents the average price over the last roughly 8 months.
Right.
When the current price hits that line from below, it represents the break-even point for a massive amount of investors who have been trapped underwater for months.
Oh, I see. So the moment the price finally gets back to what they originally paid.
They just want out.
Exactly. It's sheer relief.
Precisely. They sell just to break even, which creates a massive wall of supply that stops the rally dead in its tracks.
That makes total sense.
And the Fibonacci retracement levels act similarly. Algorithmic trading bots and millions of human traders all look at that exact same 0.382 level.
So it's a self-fulfilling prophecy.
Exactly. Because everyone expects a reversal there, everyone sells there.
Wow. So what does this all mean for the rest of the year? Are we just heading lower?
Cowen's forecast warns that June is historically a major turning point. He sees a potential grueling decline going deep into the fourth quarter of 2026.
Deep into Q4. That's months away.
Yeah. And this is actually very typical for midterm year cycles. If the traditional stock market goes through a correction later this year, that could be the exact catalyst that pushes Bitcoin into a second major sell-off.
And there are already warning signs under the hood, aren't there?
Yeah.
Cowen highlights that despite the recent bounces, Bitcoin is currently underperforming gold, stocks, and even energy markets.
Which is glaring.
Yeah.
When the premier speculative asset is underperforming safer havens during a so-called rally, it tells you the market's underlying strength is totally hollow.
Okay, so we've got heavy macro pressure with inflation and a strong U.S. dollar, and the technical charts are screaming that we are in a psychological bear trap.
Right.
But I actually want to circle back to the U.S. dollar for a moment, because while the traditional dollar is causing chaos, there is an absolute war going on behind the scenes over digital dollars.
Here is.
This is laid out in our summary from Coin Bureau, and it revolves entirely around stablecoins.
Yes, and this might be the most crucial piece of the puzzle for you to understand today.
Definitely.
When we talk about the crypto market, everyone naturally hyper-focusates on Bitcoin. But the actual plumbing of the entire ecosystem, the rails that everything runs on, are stablecoins.
Right. Primarily Tether, or USDT.
Exactly.
And the sheer scale of Tether right now is mind-blowing. I mean, according to Coin Bureau, Tether currently holds an astonishing $141 billion in U.S. treasuries.
Let that sink in.
Seriously, every single time someone, anywhere in the world, buys USDT to trade crypto, Tether takes those real dollars and buys U.S. government debt.
Which directly fuels global demand for the dollar.
Wait a minute. Here's where it gets really interesting.
Yeah.
The entire decentralized crypto revolution was literally invented to bypass the U.S. banking system and government fiat.
That was the whole original ethos.
But now the biggest liquidity provider in crypto is taking everyone's money and using it to act as the largest buyer of U.S. government debt. Are you kidding me?
The irony is incredible, isn't it?
It's unbelievable.
And what's fascinating here is that the U.S. government secretly loves this arrangement.
Oh, of course they do.
Right.
Yeah.
At a time when some global superpowers are actively trying to de-dollarize and step away from U.S. debt, Tether is effectively acting as an unofficial, massive, offshore branch of the U.S. Treasury.
Wow.
It actively strengthens global dollar dominance.
But clearly, not everyone is happy about this. The summary notes that Europe is aggressively fighting back.
And they have to. Europe fears that if global citizens and businesses increasingly use dollar-backed stablecoins like Tether for everyday transactions, it will completely undermine the euro.
Oh, because why use the euro if a digital dollar is faster and universally accepted?
Exactly. If your citizens are transacting in digital dollars, the European Central Bank loses control over its own monetary policy.
So they're weaponizing regulation. They've introduced the MiCA rules, the markets in crypto assets regulation.
Right.
How exactly does that stop Tether?
MiCA is surgically designed to limit the power of non-euro stablecoins. It imposes incredibly strict reserve requirements and hard transaction caps.
Hard caps on volume.
Yes. Under these rules, if a dollar-backed stablecoin gets too large or sees too much daily volume inside Europe, regulators can literally force them to stop issuing tokens.
Wow. And it isn't a theoretical threat, right? It is already happening.
Yeah.
Major exchanges like Binance, Kraken, and Coinbase have already restricted or completely removed access to USDT for their European users just to stay compliant.
Because Europe's ultimate endgame isn't just about limiting Tether.
What is it then?
They want to clear the entire playing field to launch a digital euro that is entirely controlled by the European Central Bank.
So everyday crypto traders who just want to park their money in a stable asset between trades are unwittingly acting as foot soldiers in a global geopolitical proxy war.
That is exactly what is happening. Stablecoins have evolved entirely beyond their original purpose.
They really have.
They are now heavy artillery in a fiat power struggle. The U.S. is expanding dollar dominance through the blockchain, while Europe is actively trying to crush it to protect the euro.
Unbelievable.
And meanwhile, fully compliant U.S.-regulated stablecoins like Circle's USDC are stepping into the void left by Tether in these regulated European markets.
Wow. Okay, so to recap where we are for you listening, the macro environment is draining liquidity, the technicals show we are likely in a psychological bear trap, and global regulators are going to war over the very stable coins that keep the market functioning.
It paints a pretty bleak picture.
It really does. If I'm
Yeah.
listening to this, I'm probably wondering why anyone is still investing in this space right now. Where is the hope?
Well, the hope is found in the final piece of our source stack today, the defiant outliers.
Yeah.
Because even in a market this heavy, not everything is bleeding. But the projects that are surviving have one major thing in common.
Which is?
They are completely abandoning the old ethos of pure speculation and anonymity, and they are aggressively leaning into compliance and real-world utility.
The prime example in our newsletter is a platform called Hyperliquid, and its token, HYPE. They are literally calling it the last coin standing.
And for good reason.
Yeah, despite everything we just talked about, the macro storm, the bear trap HYPE has maintained a steady uptrend since January.
And it isn't driven by empty promises or hype, ironically.
Right.
It is driven by real product demand and serious institutional integration. They are officially linked with Circle and Coinbase.
Big names.
Very big. And the newly launched HYPE ETFs are seeing massive inflows. The newsletter notes that 21 shares just posted a record trading day for their hyperliquid ETF.
But the truly defining factor seems to be their founder, Jeff Yan. He isn't hiding behind an anonymous avatar on Twitter.
No, not at all.
He is actively meeting with U.S. policymakers. He is pushing for something called the Clarity Act, which aims to bring regulated on-chain derivatives access directly to U.S. users.
And this is a massive paradigm shift. For years, the decentralized finance space viewed regulators as the ultimate enemy.
Yeah, the whole code is law mindset.
Exactly. But founders like Jeff Yan realized that regulation isn't a death sentence, it's a bridge.
A bridge to where?
To institutional money. If you bring a decentralized exchange into strict compliance, yes, you might lose some retail traders who want to remain completely anonymous.
Right.
But you unlock the trillions of dollars controlled by hedge funds and asset managers who are legally required to trade on compliant platforms.
I see. It really is a tale of two cities right now. I mean, in the News Digest, there was a story about the Virus Ethereum bridge getting hacked.
Oh, yeah.
They lost over $11 million in an exploit, and the attackers washed the stolen funds through Tornado Cash.
Classic old school crypto crime.
Exactly. And for those of you who aren't in the weeds on this, a mixer like Tornado Cash takes your crypto, scrambles it up with everyone else's in a black box, and spits it out untraceably. It is the ultimate tool for the old lawless era of crypto.
And capital is actively fleeing from that lawless era.
Because right next to that hacking headline, we see that Japan's biggest traditional brokers, massive institutions like SBI and Rakuten, are building their own safe, in-house crypto investment trusts.
Right.
They're building bank-grade vaults, while the old crypto bridges are still getting robbed.
That contrast is the entire story of the market right now. Capital is moving from the exploitable, unregulated fringes directly into compliant institutional-grade vehicles.
And it isn't just the financial infrastructure changing. It's what people are actually trading.
Yes.
Look at OpenSea. They were the epicenter of the NFT craze. You know, people trading speculative pictures of digital monkeys.
Everyone remembers that phase.
Yeah, well, they are completely evolving their business model. They announced that their next wave is moving away from pure digital speculation.
Thank goodness.
Right. They are focusing on tokenizing physical, real-world assets, Rolexes, Pokemon cards, high-end event tickets, AI-powered digital ownership.
They are turning highly illiquid physical assets into liquid globally tradable digital assets on the blockchain.
It really feels like the Wild West is finally getting sheriffs and banks. It seems like the market is looking at all these projects and delivering a very clear ultimatum: grow up, get regulated, or get out.
That is the reality check the industry desperately needed. Retail traders often hate the idea of regulation, viewing it as the government trying to ruin the fun or control the code.
Sure, nobody likes red tape.
But what these sources show us is that compliance is the mandatory key to unlock the institutional capital sitting on the sidelines.
Yeah.
Harvard isn't going to buy a token on an unregulated hackable bridge that washes money through Tornado Cash. They are going to buy regulated ETFs and trade on compliant platforms.
Okay, we have covered an incredible amount of ground for you today. Let's do a quick recap.
Sounds good.
We started with the mystery of Bitcoin's price dropping despite a $2 billion buy. We found the answer in a heavy macroeconomic storm where inflation fears and a surging US dollar are forcing institutions to pull their liquidity out of the market.
Then we looked at the technical charts,
Right.
which warned us that this recent green streak might just be the receding tide before a tsunami, a classic bear market trap snagging retail investors.
And then we uncovered the massive irony of Tether. The fact that a crypto stablecoin holding $141 billion in treasuries is essentially acting as an offshore arm of US dollar dominance.
Which, as we saw, has forced Europe to fight back with strict micro-regulations to protect the euro.
And finally, we looked at the platforms surviving the storm, like Hyperliquid and OpenSea. They are proving that the future of the market relies entirely on embracing regulation and bringing real-world value on-chain.
It's a completely new era.
It is. Which brings us to the end, but it leaves us with something huge to think about.
Yes. This raises an important question, and it is something for you to really mull over as you watch the charts this week.
What's that?
We talked about the SpaceX IPO potentially draining traditional liquidity, and we talked about OpenSea moving to tokenize physical assets like Rolexes.
Yeah.
If traditional tech companies like SpaceX and physical assets like Rolexes are soon going to be tokenized and traded on the exact same regulated on-chain platforms as Bitcoin and Ethereum.
Oh, wow.
Will the boundary between the crypto market and the traditional stock market completely disappear by the end of this decade?
That is a phenomenal question. Are we even going to have a separate word for crypto in 5 years? Or is it all just going to be the market?
We'll have to wait and see.
We will. Well, thank you so much for joining us on this deep dive. As always, keep questioning the headlines, look for the macro currents beneath the surface, and we will see you next time.